Hey guys, welcome back to the channel. This video will simply be a continuation of my previous video explaining exactly what option contracts are, how you can trade or invest in them, and how you can potentially make substantial gains with the risk of losing money at the same time. For those of you who are not familiar as to what option contracts are, I advise you to check out my previous video on option contracts as I break down and really simplify both call and option contracts for you. In the previous video, I do explain the details of a call option while also providing an example. So in this video, I will focus mainly on the other type of option contract you can purchase, known as a put option. The put option gives you the right, but not the obligation to sell 100 shares in the contract at a set price, known as the strike price. As an example, say you think the share price of Apple is going to decrease in the next 6 months. What you can do is you can buy one or multiple put option contracts, which gives you the right to sell 100 shares in each contract at a set price. The put option may look something like this. One Apple, November 19th, 2021, 145 put at $9 limit. So, one Apple stands for one Apple put options contract. November 19th would be the date this contract expires. 145 would be the strike price or the set price per share you can exercise the contract at, and $9 would be the premium. How this would work is, say the Apple share price is currently trading at $146, with the strike price on this contract at $145. This means that between now to November 19th, the expiry date of this contract, if the share price was to go below $145, which is your strike price, say it goes to $120 in the next 3 weeks. This means that you would be called what is in the money. You have made profit on the options contract since this contract gives you the right to sell the 100 shares at $145, even though the shares are now trading at $120, and you have the flexibility to either sell the contract itself, take the gains and move on to something else, or exercise the contract, sell the 100 shares at $145, and open up what essentially would be called a short position. Now, you may be asking, what is the $9 premium for? The $9 premium is what you pay per every share in the contract to be able to own this contract. This is essentially the price you pay to buy the contract itself, excluding any additional commission fees that your broker may charge. So in this instance, to buy this one put option contract, which gives you the right but not the obligation to have to sell the 100 shares, it would cost you 9 times 100 shares, equaling $900. In a way, from the time that you purchase this one put option contract, you can say that your break even per share would be around $136, since your strike price is $145. In this instance, instead of adding, you would be subtracting the $9 premium you paid per share from the strike price. This is because for call option contracts, where you need the share price to go above the strike price to make a profit, for put options, we need the share price to go below the strike price to make a profit. Now, as explained in the previous video, the time decay and risks are also associated with put options. If the share price drops significantly below the strike price in a shorter period of time, way before the expiry of the contract, say the share price were to drop from $146 to $110 within 1 week of buying the put option, the contract's value would appreciate more significantly. However, if the share price fails to drop below your strike price up until expiry of the contract, or if the share price exceeds your strike price of $145, your contract will expire worthless. This is because the shares can now be sold on the market at $160 when your exercise price on the contract is only $145. The value of your options contract will constantly fluctuate based on how the company's share price is trading, and also based on the time passing by until expiry of the contract. This is why you have to monitor the contract closely, and also why, although you may be able to achieve huge gains in a much shorter time span rather than just owning the stock, they do come with much more risk due to the expiry and time decay of the contract, where you can end up losing everything. Now, another thing to note with option contracts, there are two types of option styles that you will be purchasing for either call or put options. These would be known as American style options or European style options. With both option styles, you are able to sell the contract itself at any time, should you have made what you think is an adequate amount of gains. However, when it comes to actually choosing to exercise the contract instead of just simply selling the contract, with American style options, you can exercise the option contract at any time before expiry and actually purchase or sell the 100 shares in the contract. This is a great benefit to have, as it provides you the flexibility to exercise the contract and own the shares at any time if that is your eventual goal. American style options tend to be more common that you may likely run into, and due to the flexibility associated with them, they do tend to be more expensive. With European style options, you can only exercise the option contracts on the day of expiration. However, you can still sell the contract itself at any time prior to expiration. Most index and forex options tend to be European style options, therefore they may be less common. Because they are in a way more limited, European style options tend to also be cheaper. Well, that's it for this video. I hope this mini tutorial series on call and put option contracts was helpful to anyone looking to understand how they work, if you are planning to buy these types of option contracts, or if you're just simply looking to understand them. If you enjoyed the video, kindly feel free to like it, subscribe to the channel, and ring the bell for notifications. And until then, stay safe and we'll chat soon.